As we promised in a recent video, today's video is special. I had the pleasure of sitting down to speak with Cathy Clopton. She's a CPA who works with many of our clients to relay to her the most commonly asked questions that we receive from clients during tax time. So that way you can hear directly from her, a tax professional, on some of these tax hot topics. Enjoy the video. Another message from me to come at the end. I appreciate you taking the time, especially during your busy season. So it means a lot. I think our clients will really benefit from this. So for people who have maybe not worked with a CPA ever, and are maybe considering it, because that's another question we get a lot, which is, hey Seth, hey Mike, hey Chris, Rob, Elizabeth, should I be working with a CPA, right? Or can I just continue to kind of DIY it with software? What's your thought process on that? I mean, like, what's kind of like a red flag of like, oh, you need to talk to a CPA?
Just to know that it's being done correctly and on time. And if you can't file it electronically yourself these days, it's worth paying someone to do your return that can e-file it, because you've probably read in the paper, I saw the National Taxpayer Advocate, which is kind of an adjunct to the IRS, spoke before the Senate Finance Committee last week, and between unprocessed paper returns, amended returns, which have to be done on paper mostly, and paper correspondence, there are 24 million unprocessed pieces of paper in the IRS right now. That's their backlog. 24 million. About 8 million of that are returns, about 8 million are amended returns, and the rest are correspondence trying to straighten out stuff with the IRS.
Goodness gracious.
So if you can avoid sending any paper to the IRS right now, you need to do it.
So for someone who's going to reach out to a CPA, maybe for the first time, what are some kind of best practices that they should be aware of when interfacing with the CPA?
They should always produce at least the prior year tax return, because that's kind of a roadmap for the CPA to know what to look for in the current year, or how to give them an estimate of the cost of a return, or just prompt some questions. And then they need to, and if you're talking about at tax time itself, they need to gather all those tax documents. Be aware that January 31st is the deadline for a whole lot of returns information returns to come in the mail. Brokerage account information can come anywhere from the middle of February to the end of February because of extended deadlines for them. And just to have everything together, and any questions you have those all enumerated before you submit your information or meet with the CPA. There's nothing worse from the CPA standpoint to be working a return and you get all the way through it and you realize there's 3 pieces of information and you have to, it's like pulling teeth to get the rest of it. So try to be complete, because that's better use of my time, and all I have to sell is my time. That's my inventory. So the more times I have to come back and revisit your return, that's more time and increases the fee.
Yeah. Well, so you mentioned costs, and I was going to ask about that. What should people expect? I guess kind of what's the norm in your industry as far as engagement type and cost and things like that? So a lot of firms will, or I guess some firms will have kind of that minimum, all-in fee, right? And then is it also kind of like an a la carte thing? Like if it's this form, it's that fee. Or is it per return, or is it a retainer, or different things?
It's kind of it's more value based to me. It's what are you getting for your money? So we quote a minimum because there are just 2 of us and we have to draw the line somewhere. And then depending upon the complexity of your return, the forms that are involved and the complexity of those forms, how you submit your information, does it come in organized or is it in a shoebox? That's an indication of how much time. That's what kind of determines the rest of the fee, and it goes up from there. And no one's return is alike. No, they're just all different. And so that's why we can give you a range. I would say, most of ours are within a certain range, but I hate to quote that sight unseen until I've, taken a look at somebody's information and had a talk with them. Some people are really great compliant clients, and some taxpayers are not very compliant. So,
okay, it's tax season. Let's jump into a little rapid fire tax Q&A. Right. So this should be fun.
Pop quiz.
Pop quiz. Yeah. Oh, I'm sure this will be a breeze for you, but our clients will appreciate it a lot. So, so let's jump right in here. Let's talk about deductions. right? Itemization versus the standard deduction. What are you seeing these days in terms of kind of the norms or what people are doing?
The norms these days, since the Tax Act, I believe it was 2018, that went into effect that practically doubled the standard deduction. We're seeing a whole lot more returns with standard deductions as opposed to itemizing. And just as a recap, itemized deductions include deductible medical, which is in excess of 7.5% of your AGI, which cuts a lot of people out. Mortgage interest, property taxes, and sales tax in Texas. Since we don't have a state income tax, we see most of those, although that is now capped at $10,000. So even if your property taxes are $15,000, you can only deduct 10. And charitable contributions, both cash and non-cash. Those are generally the itemized deduction categories. And the standard deduction right now for married joint is $25,100. So if your property taxes are capped at $10,000 out of $25,000, that leaves you $15,000 that you have to have in the other three categories: the medical, mortgage interest, and contributions. And if you're not close to that, you're gonna be better off taking the standard deduction. And if you're 65 or older, then there are even an additional amount for standard deductions. People need to know, even if they can't itemize, if they have charitable contributions in 2021, for cash contributions, you can deduct above the line $300 on a single return or $600 on a married filing joint return in
Above the
cash
line.
contributions. Yeah.
Sure.
So a lot of times I have to call and ask people for that if they forget to send it to me. And I know,
I can imagine someone maybe going the DIY route, going just clicking through the software and going charitable contributions, like, oh, well, I'm doing standard deduction, maybe just skipping that, right? So that's a good point to bring up.
Right.
And I tell you, I likewise, we look at tax returns a lot, right? And most of the ones we see are standard deduction. Sure enough, I was looking at one just yesterday. It was an itemization case. So you never know, right? Could you tell us a little bit about some of the tax breaks from a real estate standpoint? Because we kind of get this from clients a lot, kind of confusing real estate tax breaks when the real estate is used as a rental income generating property versus a primary residence or a second residence. Okay. There's kind of this thing of like maybe the real estate agent told them they're buying another property. Hey, these are going to be great tax breaks for you. Could you speak to that?
Sure. Let's talk about primary residence and second residences or second homes for a minute. If you itemize, you can take mortgage interest and taxes on both a primary residence and a second residence. So if your first residence doesn't put you over the standard deduction, if you have a second residence, maybe those costs will, although the taxes are going to be limited to that $10,000, but maybe the mortgage interest will. If you sell your primary residence, and right now, the way the tax code is, if your gain on a married filing joint return, not the sales price, but the gain over and above your purchase price is not $500,000 or more, it's not even reportable on your tax return. And that level is $250,000 on a single return. So
now I want to highlight that you said the gain amount, right? Not necessarily the sales price.
Right. So a lot of times people say, oh, I sold my house and I made money on it, and they did, because look at this market we're in. But if I look at their closing statement and even the gross proceeds aren't $500,000, then I know their gain can't be 500. And I'm like, you don't have a thing to worry about. And they're thrilled, because they thought they would have to pay. So it's the difference in what your net proceeds are after closing costs and what your cost basis in the house is, including major improvements. So a lot of times, depending on what part of town you're in, and of course, if you're in Highland Park or an area like that, you may hit that gain really quickly. Maybe in Garland, you might not. So just a difference.
Sure.
As far as rental property goes, you can deduct all reasonable expenses that you incur on that property, including mortgage interest and taxes, without a limitation on the taxes in that case, as long as the property is available to rent, even if it's not rented. So maybe it's been on the market, but it just hasn't rented. That's probably also not the case in this market. But you get to deduct 12 months worth of expenses, even if it was, say, only rented for 9 months, as long as it was available to rent. You weren't renovating it or something. There's a caveat on rental property. This may be more than everybody wants to know, but unless you're a real estate professional, it's considered a passive activity. Mm-hmm. And in the IRS code, if you have a loss on that property, which even though it could cash flow positively, sometimes you collect more rent than your expenses. Because of depreciation, which is a non-cash expense, you could have a tax loss, even though you have a positive cash flow. If your adjusted gross income is 150,000 or more, you can't deduct that loss currently. And I think a lot of people are unaware of that. You don't lose it. It just gets suspended. It gets suspended until you have passive income. Maybe the next year, you don't have as many expenses. It has a positive tax. It's a net income from a tax standpoint. You can absorb that loss that you deferred the year before and offset it. If you have a loss every year because of depreciation, those losses continue to accumulate indefinitely, and you can deduct it against the gain when you ultimately sell it.
Okay, so those losses
they're not
just
lost,
kind of accumulate. You use them eventually, right?
Right. They're not gone. They're just deferred until you either have passive income or until you sell the property.
Okay. No, that's really helpful. And those are kind of the common questions we get is I sold my house. I'm gonna have to pay taxes. It's like, hold on, let's check your numbers here, right? So capital gain on primary residence. And the other was kind of interest on a primary, secondary residence versus a rental. You spoke to that.
Right. They're they're reported two different places on the return. Exactly.
Right. Okay. And then again, if you're doing standard deduction and your mortgage interest on a first and second home, it still doesn't exceed, right? Those categories still don't exceed the standard. You may not be reaping any additional tax break per se on a second residence, for example, unless you're itemizing.
Correct.
Okay.
Correct.
No, that's really helpful. Another strategy that a lot of folks are doing, particularly our retirees, are doing Roth conversions. So tell us a little bit about that from your perspective. Is that something you're seeing a lot of, or who typically does that kind of a thing? So people can kind of understand that.
I see some. I don't see a lot. Generally, when I have Roth conversions, I usually work with whoever their advisor or their planner is, and we see how much room they have to take a conversion without perhaps bumping them up in the next tax bracket. I think it's
and you know what? And I just realized we didn't even define what a Roth conversion is for anyone who's watching who doesn't know. So I didn't mean to jump in there, but
no.
Yeah, for those ones who's watching, that would be when you voluntarily take funds from your traditional retirement account and move that into a Roth retirement account, right? So for traditional IRA to a Roth IRA, it does add to your ordinary income for that year. But once it's in the Roth, it's goes tax free, and then distributions, if they meet the qualifications, are tax free as well. So that's what we're talking about if you didn't know already. And so sorry, Cathy, I interrupted you there.
That's okay. And it's a great strategy to do because it gives you retirement, both taxable and non-taxable retirement income, or it keeps you maybe from having to take required distributions from that Roth if you don't need to down the line. It kind of saves it still tax-free for a legacy, if you will. You have to also, besides the fact that you kind of don't want to step up into a big tax bracket unknowingly, you have to also watch to see what a conversion will do to your adjusted gross income, because so many things are triggered to the adjusted gross income number. For instance, the stimulus payments that people got over the last couple of years were all triggered to AGI. And so if you have a spike in your AGI, it could do something like that. Another thing, if you're on Social Security and you're paying Medicare, there is something, used to everybody paid the same thing for Medicare, and several years ago something called IRMA crept in, and basically now it's on a sliding scale. You pay more, the more income you make, the more you pay for your Medicare. So if you have a spike in one year due to a Roth conversion, then it may cost you more for your Medicare premiums the next year. So there are just a lot of things that come into play when you're messing around with your AGI. So
that's right.
That's why it's good to kind of do an analysis,
right?
Yeah,
exactly. Yeah, because you're looking at marginal bracket thresholds. You're looking at the IRMA thresholds. So a lot to keep in mind. And we do see that a lot of our clients who do the Roth conversions, they do use it as a future required minimum distribution kind of mitigation strategy.
Right.
We'll project their taxes out into the future, and it's like, goodness, your tax rate is going to spike, or your tax liability is going to spike at age 72 when you have your RMDs. And so we try and kind of backtrack into the now and each tax year along the way and try and maximize those marginal brackets and even that out.
Right. I think
Yeah.
I think the reason I don't see it as much is because I think there are a lot of people that are just not aware that you can do it because they maybe don't have an advisor like North Texas Wealth, or, they're just not aware of it. They just haven't heard very much about it.
Sure.
So.
Yep. Okay. Okay. Next up, let's talk gifting and inheritance. What are some of the common questions you receive on the gifting front, and/or, hey, a loved one passed, I'm getting this inheritance, do I have a tax? Can you kind of talk us through that?
Okay. Let's talk about the inheritance part first. It's not quite as confusing as the gift. On an inheritance, if you inherit assets that are post-tax, if someone has a checking account or CDs that they've earned their money, they saved it, they put it in there, they've already paid the tax on it, and you inherit that, there are no tax implications on that at all. If you inherit someone's IRA or 401k, anything that's pre-tax, then beneficiaries are going to have to pay tax on that. If you inherit stock, you get what's called a stepped up, currently, you get what's called a stepped up basis. So if someone bought IBM stock for $100 years ago and they pass away, you inherit it at whatever value IBM is on the date of death. And so the gain between when they bought it, what they paid for it doesn't matter anymore. It's what it was valued at the date of death. So a lot of people think, oh, I got all this money and I'm going to have to pay all this tax. And normally, unless there's a large qualified account that they have inherited, that's not the case. So that usually comes as a big relief to them. On the gift tax side, gift tax is it's confusing. It's a little bit of a misnomer because a gift is never income to the recipient and it is never a current income tax deduction to the donor. So there's no income tax reason to give it away. The reason people gift, other than just the goodness of their heart, a lot of times from a financial standpoint, is they're trying to get their estate down below the estate tax exemption. And so you can give away in 2021 $15,000 to as many people, as many individuals as you want to. They don't have to be related. It could be your CPA, could be your planner, it could be anybody. That exclusion is going up to $16,000 in 2022, by the way, or has gone up. So when you give a gift that's more than that exclusion, say you give $85,000, the first $15,000 is excluded from gift tax. So that gets you down to $70,000 of what is referred to as a taxable gift. But technically there is no tax on that. It just reduces your estate exemption when you die. Currently, the estate exemption per person is a little over $12 million. So you would take 12 million, you would subtract the 70,000, and you still got $11,930,000 or something like that. So most of my clients can give away everything they have and still not have to pay any gift tax. You technically have to file a gift tax return because that accumulates the gifts from one year to the next, even if there are gap years in between. But there is no tax due until you have completely absorbed your estate tax exemption. And that exemption, that $12 million, is per person, not per couple. So
it starts to add up pretty quickly. You're talking about a married couple,
Right.
Well, and what? That's one thing that we see a lot of times is people will still kind of adhere to that annual $15,000 gift per recipient, even though they're clearly under no danger of incurring any type of estate tax. So what do you think? Is that more of just a mental convenience factor? If I don't want to file this additional form to report this and track my lifetime exclusion amount, is that kind of what it boils down to?
It could be that. It could be just because that's what they've always done, is just given up the exclusion. Maybe an excuse not to give away their money to their kids any sooner than, maybe the kids want it. They can say, sorry, I can only give this
guys,
much.
Yeah.
I don't know. It's hard to say on that. So,
right,
one thing to remember as far as a strategy goes, if you are trying to get some money to your kids, a lot of people want to help their kids. Everybody wants to help their kids, but a lot of people, there's really a big need and they want to get them more money faster. So if you've got a married couple, they can each, giving to a married couple, say a son and a daughter-in-law, they can each give $15,000 to each. So that's $60,000 they can give in 1 year without having to go to the trouble to file a gift tax return, even though there's no tax involved. And they could give $60,000 in December, and turn around and give another 60 in January in the next year, and give them $120,000 pretty quickly with no filing required.
That's great. Yeah, I mean that's a lot. And then a lot of people aren't aware, there's certain types of gifts you can make for a medical expense or for education for someone, where you can instead just write that directly to the institution or the professional, and then now you have to worry about the reporting factor as well, right?
Exactly. Good point.
Yep. So we see a lot of that on the inheritance. Talk about life transition, right? A lot of times people will come to us, and you even said come to you when they receive an inheritance or something like that. So we do see a lot of that. People confused. I'm getting all this money. I'm going to owe taxes, right? So the concept of the stepped up basis, and again, we should say all of this is under current tax law, right? Which is subject to change
Right.
at any time. So we also see that from the previous perspective of maybe an older client who has a highly appreciated asset and is thinking, oh, you know what, let me go ahead and sell this and go ahead and split it up to all my heirs, right? And then it's kind of one of those deals of like, wait. You could do that. You could, right? But here's what you need to be aware of, right? From a tax implication, doing that during your life versus an inheritance upon your death. So very important point to remember there.
And unfortunately, sometimes I find out about it after the fact when they come to bring their taxes in and it's too late. Here, a common example, doesn't happen a lot, but I've seen it multiple times over the years, to avoid probate, which is really not expensive or scary in the state of Texas, but people think it is somehow. They will deed their house over to their child. So if that's like a gift, and if you give a gift, whatever your basis was is your child's basis. So if you give a parent that's been in their house since the 1950s and they paid $10,000 for their house and they deed it over to you in 2022, your basis is going to be $10,000. And then you sell it in this market, you're going to pay the tax on all that gain. Whereas if they had just held it and left it in their will to their child, they would have gotten a stepped up basis upon their death. They all think they're doing their children a favor.
Right.
Oh, sure. It's all done with a good intent, but tax-wise, it sometimes backfires.
Yeah, and people should be aware, there's some pretty clean-cut, straightforward strategies of avoiding probate to accomplish both. Avoid probate and get the step up in basis. So before you go do something like that, talk to a professional, right?
Right.
Okay, and on the topic of giving, what about charitable giving, right? This does play into the itemization topic that we talked about earlier. But charitable giving, tax implications, is there any other thing that we ought to be aware of from a giving standpoint or a tax standpoint?
A couple of things. Well, first of all, I don't think taxes should ever be your impetus for giving. Although, it sometimes it doesn't hurt. Again, if you give enough that you can beat the standard deduction, that benefits you because you're over the standard deduction. If you can't, that doesn't mean you shouldn't give. Like I said, you could get at least 300 or 600 in 2021, even if you didn't do that. And another strategy is if you are required to take minimum distributions from your IRA, you can, right now, you take a distribution of $10,000 and say you're going to give it to your church. You can't itemize your deduction. So you've got $10,000 you're paying tax on, but you don't get an extra $10,000 that offsets it on the contribution side. You can make a direct qualified charitable distribution from whoever holds your IRA directly to the charity. It doesn't have to be a church. It can be any 501c3. It doesn't come through your hands. You don't get a charitable deduction for it, but you weren't going to anyway. But if you do the qualified charitable distribution, you don't have to report it as income.
That's great, right? Exclude that, the QCD. I'm a big fan. Just exclude it from your taxable income altogether. If you're going to give it the gift anyway, may as well do it that way.
Right. It does get reported on your income tax return, but it gets noted as a qualified charitable distribution, so you don't have to. Another strategy for charitable distributions is if you have a windfall in 1 year, say you retire, or you're retiring and you get a severance package and they're paying it out before December 31st. So you've got a spike in your income, or you sell a piece of land or whatever, you've got some extra spike. You can also invest in a donor advised funds. There are lots of brokerage firms now that have donor advised funds. And what happens with that is, say you normally would give $30,000 a year to church or a 501c3, you're regularly do that. But you have a spike, say you get an extra $100,000 in income 1 year, you could go ahead and fund $90,000, take a charitable contribution for that, which would put you over certainly the standard deduction level. Take the deduction in the year you make the contribution to the fund, and then advise the fund, I want to give this money to this charity or these charities in subsequent years. You don't get a deduction in subsequent years. You get it all in that year, but that's offsets your windfall.
Oh, that's great. And because we see that all the time, which is people come on to retirement, maybe they have a big vesting event or a big other type of a windfall event and get a bunch of stock options, and their income just spikes. And if they're otherwise charitably inclined and plan to continue giving throughout their retirement, we tell them, look, you can bundle all that and do that in year one to offset this event, and then make those distributions from the donor advised fund kind of on the same schedule you had planned otherwise.
Right.
It's good. No, for someone who's going through that, it's a huge tax savings. It's a strategy that you should be aware of. You mentioned something else earlier, which was, people may choose to reach out to a CPA at retirement. What are some of the main differences people could expect in filing their taxes as an employee or maybe a business owner versus retiree? What should they expect there?
Well, at the I level, it's a W-2 gets replaced by a 1099-R. So you think, well, I'm doing my own return. That's not so different. But sometimes when you go to a retirement income, you file a new W-4, and all of a sudden, whatever tax you were having withheld from your W-2, you haven't exactly answered the W-4 the same. You end up short on your withholding. So you end up having a gap in your income, in your withholding. If you're on Social Security often, unless you tell them, does not have any tax withheld. I would say the majority of my clients don't have tax withheld from their Social Security benefits. Mm-hmm. So if you're an employee and you're used to having tax withheld from your W-2 and kind of coming out break even on your tax return, all of a sudden, if you've got a significant amount of Social Security and no withholding, you're going to owe tax. So you either need someone to help you figure out how to make estimated payments or how much to have withheld from your Social Security. And one thing about Social Security that people don't realize, some people think it's not taxable at all, which is not true. It can be taxed up to 85%. So they can't tax more than 85%, but it is taxed on a sliding scale based on your other income. You take your other income, non-Social Security income, add half of your Social Security benefits, and depending if you're single or married, as you exceed certain thresholds, it starts becoming taxable until it gets up to 85%. And I think that's a rude awakening for some people that retire.
Mm. Yeah, they think, oh, hey, I paid in Social Security. Now I'm just going to get it. They're paying me back, right? No harm, no foul. And they're like, no, wait a second. It's taxable, right?
Right.
Yeah, or potentially taxable depending on other income sources. Yeah, right. No, okay. So that's a key distinction. Maybe people didn't realize taxability of the different income sources, and then also withholding, right? How much are you withholding from the different income sources, and is that going to be enough?
Right.
You don't want to get that first tax return, right, your first year of retirement and get a big surprise.
Right. And that happens. It does happen a lot.
Oh, I'm sure. Yeah. So that's one thing that we do for our retirees is we'll map out income sources, right? Pension, Social Security, distributions from retirement accounts, capital gains, and then kind of look at what is the expected tax liability, and therefore how much should we be withholding from the different sources to try and get ahead of that surprise.
It has been my experience, because we do have a lot of common clients, that I think your firm does a great job of looking at your clients' tax from a tax aspect. They're planning from a tax aspect. I don't think all planners and advisors do that, but I think y'all do a great job of that.
I appreciate that. Yeah, it's certainly a conscious effort of ours, right? Because it's frustrating for people to go to a financial planner, and then when tax comes up, they just say, talk to your CPA. It's like, I will talk to my CPA, but that's not helpful right now,
Right.
So no, I appreciate that. That's kind. Okay. So tax season, people are working on their taxes. What else should they be thinking about right now that maybe they're
not? Keeping records. I get this question a lot. I've done all my taxes. How long do I have to keep all this stuff?
Mm.
And the IRS, if you ask the IRS or looked on their website, they would say you should keep your tax returns forever, the actual return itself forever. And the only reason I can figure for that is because if you ever had to get a copy from the IRS, it's almost impossible to get one. And so it's just a lot easier to, and they're not thick, just your return itself. It's not very big. And so stick that in a file or a box and just keep those. As far as all the backup and support and bank statements, the IRS statute of limitations is 3 years from the date a return is filed or the due date of a return. And we generally say minimum of 5 years, you need to keep it because you never know when you're going to get one of those audit or questioning letters. And probably 5 to 7 years is a good rule of thumb. Most of my clients still have boxes in their attic.
I've seen some of those. So, okay, so kind of the timeline, the retroactive timeline is 3 years is kind of the statute of limitations for an audit. 5 to 7 years, in your opinion, would be kind of the best practice for maintaining all the support documentation. Right. As far as the return itself, the IRS's standard line is,
forever.
Hey, keep a copy?
Forever.
Okay.
I have clients that have. It's interesting to see a copy of a tax return from the 1950s. It was, the postcard that we're supposed to have now. Well, it was kind of like a postcard back in 1950.
It's funny you say that. I was sitting with a client just last week. She was kind of cleaning up, right? And she had a return from 1966. And it's kind of a piece of history, right?
Yeah. And isn't it really
your
simple?
AGI from 1966? Absolutely. Yeah. It's interesting on a number of fronts there. Okay.
But one thing that you have to be careful of sometimes, because people will just throw everything away. If you ever have to prove a basis on anything, like cost basis, which is not as hard now because now all the investment companies are required to keep it as far as stocks and investments go. But if you had a painting or a piece of jewelry or a collectible or something that you sold in the future, you'd have to retain something to prove your cost basis on that. So that's the only reason I try to caution people. If there's anything you're ever going to, or maybe your home, if you think you're going to have a gain over that $500,000 or $250,000 limit, you need to keep your records on how many improvements you've made and what they cost to put into your personal residence. So
maintaining those records, it's going to be vital, right?
Yeah.
Looking ahead at the tax landscape, I know there's some legislative things that have been kicked around. Where do you see things going? We've got a sunset event coming out here, 2025, Tax Cuts and Jobs Act. How do you see that playing out? And obviously, I'm asking you to speculate, so forgive me, right? But just kind of from your professional experience or perspective, what do you see that's on the horizon?
I think I see it more maybe just as a taxpayer or just as a constituent of our Congress right now. This Build Back Better plan can make a lot of changes and some changes to the tax law. I personally don't see it happening. I think once we get to this next November election, the midterm election, I think there may be more movement. I just think there is such a stalemate right now in Congress that I don't think anything's going to get through. And you're right. At this point in 2025, we kind of roll back, to the old rules. A lot of different things change. I have not seen much in all the tax reading that I do and things that come across my inbox that has anything very definitive about tax changes. One thing that everyone most people, a lot of people like is this $3,000, the advanced child tax credit payments and the increased amounts for the child tax credits. That's tied up in the Build Back Better bill, which is the one that is not going anywhere right now unless there's some kind of movement. And there are some things that are good in that bill and there are some things that are not good. Everybody's got a different opinion, but I don't see anything really impending right now.
Yeah. I guess what it boils down to is trying to predict tax law is tantamount to trying to predict what Congress is going to do, which is tantamount. It's basically like trying to predict Texas weather is what,
right.
What that boils down to. It's like
right.
a fool's errand, right? So you kind of just subject to whatever it is at any given time.
Right. And it usually happens right at the end of the year. So, if it's going to happen, it's not going to happen in July. It's going to happen at the end of the year or maybe January of next year.
Yeah.
And be retroactive.
Yeah. Well, hey, I appreciate you. Happy Friday. Yeah.
Thanks. You too.
Hang in there on the tax season. Okay, I hope you enjoyed that video as much as I enjoyed getting to sit down and speak with Cathy on some of these important tax topics. So you're working on your tax return. If you have other questions pertaining to your taxes or other financial planning questions, you guys, we're always here for you. Reach out to us, give us a call. One thing you may not know, we keep a list of what we call our strategic partners. This is professionals from other industries that we collaborate with at times to better serve our clients. Right. So that would be, Cathy's information is on there, other attorneys, CPAs, other types of professionals. So you can find that on our website, and that may be beneficial for you. Again, best of luck during tax time. If you have any questions, just give us a shout.